Hello everyone, welcome back to All Financial Discussion channel. For this video, I'd like to continue the discussion. How can we actually tell if this stock is still a good buy? On my previous video discussion, I have used price to earning to determine if this stock is still a good buy. This video, I will use something quite similar, which is price to earning growth, which is also known as PEG, in order to determine if this stock is still a good buy. From here, you can see that basically the equation is price to earning with respect to growth. For me, there are actually two types of price to earning growth. One is to use predicted growth, which means that 1 year ahead, what kind of growth that you actually predicted. Another equation will be the price to earning against the historical growth. So I personally prefer to use historical growth because from there I will be able to know how good or how much the company can actually grow in 1 year, and then basically use that as a gauge to determine if this stock is still a good buy. Basically from this video, I will use an example. I will still use the example of Coca-Cola to determine if this stock is still a good buy. So basically all this will be the objective of this video. Before I continue, guys, this is very important for me. I urge you to help me by like this video. Guys, it's free. Just give me a few seconds. Press the like button now. For those who are new to this channel, and if you want to encourage me, please consider to subscribe and turn on your notification bell. Once again, thank you so much for strong support. A quick disclaimer. So this is not a financial advice. Please conduct your own independent research and consult a professional if needed. Never invest more than you are willing to lose. With this, we are ready to kickstart today's discussion. This method, price to earning growth, is widely used by this investor, Peter Lynch. So basically, he actually formulated this as a very simple way to spot the winning stock. So basically, how can we actually compute the price to earning growth ratio? Is actually equals to price to earning, which I have explained based on my previous video. From here, you can see that it's actually divided by growth. So the growth can be two types. One is predict growth, which means that you look ahead. For example, 1 year, what will be the growth? Another one will be based on historical value, based on last year growth. So basically you can use this to determine this price to earning growth ratio in order to spot the winning stock. So like I mentioned earlier on, this investor, Peter Lynch, has actually formulated this very successfully. So these are all the different ways how can we actually tell if the stock is still a good buy. As I mentioned earlier on, this video, I have already explained how can we actually use this price to earning ratio to determine if this share is still a good buy. This video, I will concentrate on this PEG, which is price to earning growth ratio. So typically, we want this PEG to be around 1. In fact, to be more precise, slightly less than 1. In order to quantify that this is still a good buy. So I'm going to explain later on why. Price to earning growth ratio, in fact, is a stock valuation matrix that actually refine the widely used price to earning ratio by incorporate another new term, which is the company expected earning growth rate. So this is the equation that I mentioned earlier on. Based on my previous video discussion, we can easily compute the price to earning ratio. So basically from this equation here, you can see that it actually respect to the so-called growth rate. So the growth rate, like I mentioned earlier on, can be forward or backward, as it illustrates over here. So it can be over 1 to 5 years. For me, I think 5 years to look forward is almost very challenging. For me to look for 1 year is already very difficult. So for me, typically, I will use it for only 1 year. But for my backward looking, based on my historical reading, I will read for 3 years. So basically, this is how we can actually compute this PEG ratio. So later on, I will give you an example. But for most of the time, I actually use this price to earning growth based on which stock to buy. For example, I have two companies which I do not know which stock I am going to buy because both have a very attractive price to earning ratio. Basically, I will use this PEG ratio in order to determine which company to buy. Okay, so basically, how can we interpret this PEG? Okay, so this PEG, in fact, will help investor to determine whether a stock price is justified by its earning growth potential. For example, when PEG is equals to 1 or close to 1, okay, you can declare that the stock will be a very fair value. Okay, basically, the growth actually match the price to earning. But when PEG is actually less than 1, this is desire. Okay, so this has a huge potentially undervalued. So basically, the growth rate actually exceed the price to earning ratio. While when PEG is actually more than 1, which means that the share price is probably overvalued because the price to earning ratio actually exceed the growth rate, which is undesired. So therefore, for us, we need to look at the stock which is PEG equals to less than 1. So this is what we want. So basically, I will give you an example later on. Let's come to the advantages and also the disadvantages when we actually apply this price to earning growth to predict whether this stock is still a good buy. Let's firstly come to the advantage. This actually account for growth. Okay, so this is actually the strongest advantage. If we are able to predict the growth, then this price to earning growth will be very useful because okay, the price to earning okay, alone, they can only predict so-called currently, and maybe for forward price to earning, they can predict slightly ahead, but they actually neglect the total growth of the company. So this is very useful if let's say we are able to tell ahead what will be the company growth. Next will be comparative tools. Okay, so this is what I mentioned earlier on. For example, when we want to compare two different companies, okay, but they are in the same industry, okay, but they actually have different growth rate. So from here, you will be able to tell which stock is still a better buy. Okay, so basically this video, I will give you an example later on. Next, simple and intuitive. Okay, basically, it is very easy to calculate. Okay, if all the data are all available. Next, let's come to the disadvantage. Okay, firstly, it actually rely on estimate. As I told you earlier on, if we are able to tell ahead, okay, but most of the time we are not able to tell exactly ahead. So therefore, all these are forecasts, and there's no guarantee, and therefore they can be inaccurate. Next, this is actually very sensitive to time frame, okay, because they actually have all different growth period. In fact, different people actually will predict different growth also. So therefore, for me, okay, it is always very challenging. And for example, if you predict against 1 year or 5 year, the number can be very different. Next case, so basically when we actually use this price to earning growth, it actually ignores all other possible factors. For example, they does not account for any debts, they does not account for any market condition or even industry cycle. This will be less useful, okay, for those companies that is not growing or they are actually very volatile, which means that the earning is a lot up and down, very hard to predict, and it is almost very challenging to use this price to earning growth to estimate the company potential. Next, let me give you an example. Okay, so as I mentioned early on, when we actually use this price to earning growth, typically we want to compare two company. From here, you can see that I have company A and also company B. Okay, so from this example, I will show it to you which company is actually have a so-called better share as compared to the other one. For example, okay, let's say all these company, okay, all this data can be easily found from the company A, and all this can be easily found from company B. Okay, so firstly, let's quickly compute what will be the price to earning ratio. Okay, how can we actually predict this price to earning ratio? Okay, it will be simply the price per share, okay, against the so-called the earning per share this year. Okay, so basically this is how we can compute. And from here you can see that we have compute that this PE ratio to be equals to 22. Okay, so basically if you still remember for value stock, let's say this is a value stock, we want this PE ratio to be as small as possible. So likewise, we can also do the same thing for this company B. So all this data can be easily found from, let's say, the Yahoo Finance, etc. So from here, we can compute the so-called price to earning ratio. Okay, again, it will be the price per share divided by the so-called the earning per share this year. And from here, you can see that I have successfully computed that this price to earning ratio is actually 30. And as I mentioned earlier on, okay, so if let's say these two are all value stock, so basically we can tell that which one is smaller, then is considered a better buy. So from here, you can easily see that this company A will be more attractive because this number is actually smaller as compared to company B. So hence, with this data, I will just buy company A. However, when we actually incorporate into this price to earning growth, okay, so this actually show another dimension. It will show the dimension of growth of the company. If you still remember the equation clearly, the first one is actually on the share price. This is actually on the so-called earning per share. Okay, we also need to take care of the share price because we also want to have a higher share price so that when we actually cash out, it will be more attractive. So hence, for this price to earning ratio, we basically do not concern so much in terms of the price of the share. But for this price to earning growth ratio, basically this will be under the consideration. So now let's say we can compute the earning growth rate. Okay, so how we can actually compute over this? Basically, this will be the EPS for this year over the EPS for last year. Okay, so basically, you can take a historical data, which is more accurate. And from here, you can see that the earning growth rate, which is 20%. Okay, make sure you also do this -1 over here. You can compute that it's actually 20%. Same for company B, you can do exactly the same. So how you can actually compute this? So this will be the EPS for this year. This will be the EPS for last year. Okay, basically you do a division. After that, you do a -1. From here, you can see that the earning growth rate is 50%. Based on this data, which is the earning growth rate, you can see that company B is more attractive because the company B, let's say the share is growing like 50% as compared to the company A, which is 20%. So from here, I will be able to see that company B is more attractive. So now we put everything, okay, basically we calculate the price to earning growth, okay, which is the PE ratio divided by the earning growth rate. From here, okay, one thing I want to highlight, make sure this you do not convert them into like 20 divided by 100. Okay, make sure they are all in percentage. Okay, you put in the number here. So from here, you can see that I calculate my price to earning growth, which is 1.1. Okay, so like I mentioned earlier on, okay, it will be best if this is under 1. Okay, for this case here, it is close to 1, but not really under 1. So like with this kind of so-called condition, probably company A is not a good buy. But for company B, okay, you can calculate that this price to earning growth, okay, will be equals to 0.6. Remember, this is what I mentioned earlier on because this is less than 1. Okay, in fact, this is quite a very attractive way. So therefore, from here, I probably will invest into company B. But early on, when I just compute on the price to earning ratio, I probably will invest into company A. But with more data, with the data of the earning growth rate, now instead of company A, I probably want to invest into company B. Okay, so basically, let's do a quick conclusion. Many investors may look at company A and found it more attractive since it has a lower price to earning ratio among the two companies. But compared to company B, it does not have a high enough growth rate to justify its current price to earning ratio. Company B is trading at a discount to its growth rate, and investors purchasing it are paying less per unit of earning growth. Based on its lower PEG, company B may be the better buy. So basically, from this example, you can see that how can I actually apply this price to earning growth to compare two company, and basically based on a comparison, I have decided to pick company B as a choice to buy my stock. Before I continue, guys, can you help me by like this video? Guys, it's free. Help me press the like button now. If more you guys actually help me to press the like button, this video will have a better chances to reach out to a larger audience. So guys, help me press the like button now. if this video somehow has helped you to understand how can we actually evaluate the share, help me by subscribing to this channel and turn on your notification bell. Once again, thank you so much for strong support. Let's quickly continue. Let me give you an example how to tell if this stock is still a good buy using the price to earning growth ratio. Okay, so I'm going to use back the same example, which is Coca-Cola. Okay, so basically this is the equation to compute the price to earning growth. Okay, so firstly, I need to obtain the price to earning ratio. Earlier on my previous video discussion, I have shown it to you how can we actually obtain this value. Okay, so from here, you can see that I can easily so-called obtain this number from the Yahoo Finance. Okay, so the PE ratio of Coca-Cola is 23.34. So next, okay, I'm going to determine the growth rate. Where can we actually obtain the growth rate? Okay, for example, okay, under this Finance Yahoo again, you can actually get this so-called the earning per share growth, okay, for the Coca-Cola here. So from here, you can see that this EPS for the growth is 24.79. So what I'm going to do is I'm going to calculate my PEG ratio. How can we actually calculate this PEG ratio? Okay, will be the PE ratio. Earlier on, I did show it to you. Okay, for Coca-Cola, the PE ratio is equals to 23.35. Okay, which is over here. Okay, slightly some different. Okay, but it's still the same 23.35, and then you can divide it by the EPS growth, which is 24.79. Okay, remember this. Okay, don't divide by 100, just put this existing number, and from here you can easily compute that this PEG ratio is equals to 0.94. So what can we actually conclude? Okay, if you still remember, okay, if it's very close to 1, slightly less than 1, this is considered a good buy. Okay, so again, another way to obtain this price to earning growth, okay, from this chart over here. Okay, so I will put the link of this chart under the description. So from here, you can also see what will be the price to earning growth, okay, for today. Okay, it is 0.94 as you can see from here. So why? Okay, so basically Coca-Cola is actually a very mature, low growth company. So a high PEG is common. The market actually pay for the extreme stability and also for the dividend. So basically, in short, when you actually invest into Coca-Cola, you don't really look so much on the growth. You mainly want the in dividends. Okay, so with this, I'd like to end my discussion. Please help me to like this video and subscribe to this channel. Once again, thank you so much for strong support. I hope to see you guys soon. Bye for now. Thank you so much.